Most people believe markets move for simple reasons. A headline appears, price reacts, and the story is over. But the most important moves in markets don't begin with headlines. They begin when the market quietly stops behaving the way it's supposed to. That moment is called a freeze. A market freeze does not mean trading stops. Prices still update. Charts still move. Volume still exists. But something deeper changes. The relationship between price and reality starts to break down. Moves feel delayed, reactions feel muted, and the explanations that usually make sense suddenly stop working. This is the phase most people overlook. Before major moves in silver, the market often enters a period where price action feels wrong. Volatility drops, even though tension is rising. Rallies stall without resistance. Sell-offs fail without support. Nothing seems strong enough to push the market in either direction. That isn't balance, that's pressure. A freeze forms when confidence in the market mechanism weakens. Buyers hesitate because they are unsure whether supply will be available later. Sellers hesitate because they are unsure whether inventory can be replaced. Risk managers step in. Exposure is trimmed quietly. No one wants to be forced into a decision after the fact. And when everyone hesitates at the same time, the market stops flowing. This is why freezes are dangerous. Not because nothing is happening, but because everything is happening beneath the surface. Decisions shift from profit-seeking to preservation. Liquidity becomes conditional. Participation becomes selective. In silver, this phase matters more than in most markets. Silver is structurally thin. It depends on smooth turnover, predictable settlement, and confidence that price reflects availability. When any of those assumptions weaken, the system becomes fragile very quickly. During a freeze, price stops acting like a signal and starts acting like a question. Can this level be trusted? Can this trade be completed? Can this market still clear risk efficiently? Those questions don't show up on charts, but they shape every decision behind them. Most people mistake a freeze for calm, and they see sideways movement and assume stability. In reality, freezes are periods of unresolved tension. Pressure builds because the market is no longer expressing risk. It is storing it. And stored pressure doesn't disappear, it releases. This phase never lasts forever. Eventually, something forces resolution. Not because sentiment changes, but because the system can no longer function without clarity. When that moment arrives, price does not adjust gradually. It jumps. The mistake is trying to trade direction during a freeze. Direction isn't the point, structure is. A freeze is the warning that the market's normal pricing logic is breaking down. And once a market stops clearing risk normally, the next move is never small. In the next part, we need to understand why freezes form in silver in the first place, and what causes markets to enter this state before major repricing events. Silver market freezes don't happen because of panic. Panic creates movement. Freezes happen because of uncertainty. When participants no longer trust the process that turns orders into outcomes, they slow down. And when enough participants slow down at the same time, the market stiffens. At the center of every freeze is a loss of confidence in how the market clears risk. Silver relies on continuous participation. Prices assume that buyers and sellers are always willing to step in, that liquidity will be available when needed, and that settlement will be smooth. As long as those assumptions hold, price behaves normally. When they weaken, price stops being informative. A freeze begins when multiple uncertainties overlap. Supply becomes harder to judge. Demand becomes harder to forecast. Replacement becomes harder to guarantee. None of these issues need to be severe on their own. Together, they create hesitation, and hesitation is enough. During this phase, participants stop acting on conviction and start acting on caution. Traders reduce size, dealers widen margins, institutions tighten risk limits. No one wants to be exposed if conditions change suddenly. These actions are rational individually, but collectively they drain liquidity. As liquidity drains, the market loses its ability to absorb pressure. Small orders move price more than expected. Larger orders disappear entirely. This creates the illusion of calm even as fragility increases. That's why freezes are often misread. People look at low volatility and assume stability. In reality, low volatility during a freeze reflects inactivity, not balance. The market is not agreeing on price. It is postponing agreement. Silver is especially vulnerable to this because it sits at the intersection of financial trading and real-world use. It is traded as a financial asset, but consumed as a material. When those two roles drift out of sync, the market struggles to price risk coherently. This tension is what creates the freeze. Participants are forced to choose between acting on price signals they don't trust or waiting for clarity that may not arrive smoothly. Most choose to wait, and waiting spreads. As more participants step back, the market becomes thinner. Thinner markets are not stable. They are brittle. They can appear quiet for long periods and then move suddenly without warning. This is why freezes precede large moves. They represent a buildup of unresolved risk. The market is holding conflicting pressures in place, unable to express them through normal trading. Eventually, something breaks the stalemate. Not news, but necessity. Someone needs inventory. Someone needs liquidity. Someone reaches a limit that cannot be deferred. When that happens, the market doesn't ease into a new level. It snaps. To understand why that snap is often so violent, we need to look at how behavior changes during a freeze and why those changes set the stage for disproportionate moves. When a silver market freeze sets in, the first thing that breaks is not price. It is trust. Trust between participants, trust in settlement, and trust in the signals the market is supposed to send. Markets function on an assumption that prices reflect reality. During a freeze, that assumption weakens. Prices still move, but fewer people believe what those moves mean. The number on the screen stops being a guide and starts becoming a placeholder. This is where confusion enters. Some participants see stable prices and assume balance. Others see the same stability and sense suppression. Both groups are reacting to the same signal, but interpreting it differently. That divergence is dangerous because markets rely on shared interpretation to function smoothly. As trust erodes, behavior changes in subtle but important ways. Dealers become selective. They don't stop quoting prices, but they stop committing size. Orders are filled partially, delayed, or rerouted. Inventory becomes harder to source at posted prices. The market still appears open, but its depth shrinks quietly. At the same time, hedging becomes less effective. Normally, price risk can be offset through liquid instruments. During a freeze, correlations weaken. Hedging instruments respond sluggishly or unpredictably. This makes risk management harder, not easier. Participants who rely on hedging step back, further reducing activity. This feedback loop tightens the freeze. The more participants hesitate, the less reliable the market becomes. The less reliable it becomes, the more participants hesitate. Nothing dramatic happens, but pressure accumulates. One of the most misleading aspects of a freeze is that headlines often remain calm. There is no obvious crisis, no sharp collapse, no explosive rally. That calmness reassures casual observers, but professionals recognize it as a warning sign. Because real risk is not being resolved. It is being deferred. Deferred risk does not disappear. It concentrates. As days or weeks pass, positions that were manageable under normal conditions become fragile. Delivery schedules tighten. Replacement inventory takes longer. Margin assumptions no longer reflect reality. Small disruptions start to matter. This is the phase where participants stop asking, "What is the price?" and start asking, "Can I get it?" That question marks a fundamental shift. Markets are designed to answer questions about price. They are not designed to answer questions about availability. When availability becomes the dominant concern, price loses authority. At that point, the market is no longer discovering value. It is rationing access. This is why freezes are often followed by sudden repricing. Once availability pressures can no longer be postponed, price adjusts violently to reflect conditions that were ignored during the freeze. The move feels sudden, but it is not random. It is the release of accumulated imbalance. To understand why these releases tend to be sharp rather than gradual, we need to examine what finally forces the market to act, and why resolution rarely comes gently. That takes us to the next stage. A silver market freeze does not end because sentiment improves. It does not end because analysts agree on a direction. And it certainly does not end because prices slowly drift to a fair value. A freeze ends for one reason only. Something becomes non-negotiable. Markets can tolerate confusion. They can tolerate disagreement. They can even tolerate prolonged inactivity. What they cannot tolerate is necessity. During a freeze, participants delay decisions as long as possible. They roll positions forward. They reduce exposure quietly. They wait for clarity. But some pressures cannot be postponed indefinitely. Inventory runs low. Obligations mature. Risk limits are reached. At some point, waiting stops being an option. That is when the release begins. The trigger is rarely dramatic on the surface. There's no single headline that explains it. Instead, a routine action suddenly fails. A delivery takes longer than expected. A hedge does not offset risk cleanly. A quote is pulled instead of filled. Small frictions compound into a structural problem. This is the moment the market is forced to choose between order and repricing. Once necessity enters, behavior changes instantly. Participants stop asking whether the price is attractive and start asking whether the transaction is possible. Access becomes more important than valuation. Certainty becomes more important than optimization. That shift collapses the freeze. The reason the release feels sudden is because the pressure was already there. The market was holding it in place through hesitation. When that hesitation breaks, the stored pressure expresses itself all at once. This is why post-freeze moves often bypass intermediate levels. The market is not negotiating with itself anymore. It is responding to constraints. Importantly, the release does not require panic. In many cases, it happens calmly. Orders are executed decisively. Prices adjust rapidly. The new level is accepted faster than expected because participants were already prepared for change. They were just waiting for permission to act. That permission arrives in the form of necessity. This is also why attempts to predict the exact trigger usually fail. The release is not driven by forecasts. It is driven by thresholds. And thresholds are crossed, not announced. Once crossed, the market does not revert to its frozen state. The structure has changed. Liquidity behaves differently. Risk is priced differently. Participants remember what it felt like when the market stopped working normally. That memory alters future behavior. The freeze, in hindsight, looks like a warning. The release looks like confirmation. But in real time, the transition feels abrupt because the preparation was invisible. This is the critical lesson of market freezes. They are not periods of inactivity. They are periods of deferred resolution. And deferred resolution always arrives with force, not explanation. In the final part, we need to step back and answer the most important question: what a freeze actually tells you about the market, S next phase, and why recognizing it matters more than trying to trade the release itself. A silver market freeze is not a prediction. It does not tell you where price is going next or when the next move will happen. What it tells you is something far more important. The old rules no longer apply. Markets move in regimes. For long periods, the system behaves predictably. Liquidity is reliable. Price responds to familiar signals. Risk can be managed using established tools. During these periods, analysis works because the structure is stable. A freeze marks the end of that stability. When prices stop making sense, it's not because markets have become irrational. It's because the assumptions that once made pricing rational are breaking down. Liquidity no longer guarantees execution. Price no longer guarantees availability. Time no longer guarantees resolution. This is the shift most people miss. They focus on the next rally or the next drop, trying to guess direction. But direction is secondary. The real change is structural. The market is transitioning from one mode of operation to another. In silver, these transitions matter because the market is small and sensitive to behavior. When participants lose confidence in how risk is cleared, they don't return to old habits quickly. They adapt. They become cautious. They demand certainty where they once accepted convenience. That adaptation persists. After a freeze, even if prices stabilize, the market does not revert to its previous state. Liquidity remains selective. Volatility remains uneven. Participants remember the moment the system hesitated, and they price that memory into future decisions. This is why post-freeze markets feel different. Moves are sharper. Pullbacks are less forgiving. Gaps appear where continuity once existed. The market becomes less tolerant of ambiguity. Understanding this matters because it changes how you interpret price. Instead of asking, is silver going up or down? The better question becomes, is the market functioning normally? If the answer is no, then price alone cannot guide decisions. Structure matters more than levels. This perspective removes the need to predict. You don't need to know the exact outcome to recognize a transition. You only need to see that the system is no longer operating under familiar rules. Freezes are warnings, quiet ones. They don't demand attention. They don't force action. But they signal that the conditions supporting normal pricing are eroding. And markets rarely return to normal after acknowledging that erosion. The mistake is to treat freezes as pauses. They are not pauses. They are preparation phases. The market is not resting. It is reorganizing. When the next move arrives, it will feel sudden to those watching the price, but to those watching the structure, it will feel inevitable. That is the value of understanding a market freeze, not to trade it, not to time it, but to recognize when the game itself is changing.